Hey, what's up everybody? It is Monday, September 9th. I just sent out a new edition of MMT Trader. Lots of stuff in there. Lots of stuff. We had a big week. Very interesting numbers, by the way, in the banking data. You need to know. Very, very interesting numbers in the banking data for the week ending August 28th. Hey, guess what? The federal deficit of the United States is now over 1 trillion. Now you're hearing this first. You're going to see it in the media in about another week or two. It's going to be all over the headlines. Oh, the deficit is over 1 trillion. Oh my God, this is so terrible. This is so horrible. Absolutely the opposite, of course. The deficit of the government equals the addition to the financial balances of the non-government. That's me and you and everybody else. If the government spends $1 trillion more than it takes in taxes, that is a net 1 trillion added to the financial balances of the non-government here and rest of the world. So it is a positive, but don't expect it to be reported that way. Of course, there's going to be all kinds of hysteria, and there's probably going to be a lot of people saying this is going to be the reason why we're going into recession, when in actuality it's the opposite. And by the way, speaking of recession, let's talk about this for a second, because what happened to the inverted yield curve? Oh my God, it's not inverted anymore. The inverted yield curve is not inverted anymore. So, what happens to the recession argument? That was the underpinning of the recession argument. We had an inverted yield curve. Inverted yield curve, inverted yield curve. Oh my God, it was an inverted yield curve. We're definitely going to have a recession. Oh, the inverted yield curve is gone. It's gone. Yes, my friends, bond yields are backing up once again. Why are they backing up? Well, you know what's interesting is that still nobody has mentioned the possible theory, which I think is not even just possible. It is the theory, it is the reason, but nobody's talking about the fact that the debt ceiling created this massive distortion in the treasury market over a period of 4 months when there were no new treasuries sold, while at the same time the Fed was bringing reserve balances down, and the banks had to replace those reserves, which are tier 1 assets, with other tier 1 assets, the most likely being treasuries, of which no new supply was there. So they were bidding up these treasuries and bidding up these treasuries, and they have to do this. This is according to regulatory mandates. It's not like, hey, let's speculate. I guess there's some speculation or some position taking in the whole paradigm, but it's really because the banks must have certain quantities of these tier 1 assets to conform to regulatory guidelines and to pass the stress test. So nobody, only myself and my report, there's been nobody out there. Now, the interesting thing is that as we see the effect of the debt ceiling start to abate now, right? I mean, the debt ceiling was suspended at the end of July, and it takes time. I mean, over that 4-month period from March, when the debt ceiling went into effect, until the time when it was suspended at the end of July, over $1 trillion worth of supply never happened, okay? That 4-month period would have seen over 1 trillion of treasury supply into the financial markets globally. That never happened. So that is an enormous squeeze that was created. Now, it doesn't just all come back at the minute the debt ceiling is suspended. The Treasury sells supply piecemeal on a weekly or bi-weekly basis. And so, but now you see, as those Treasury sales have resumed, what's going on? Yields are backing up once again. Today we have the 10-year at 1.62. The yield curve is no longer inverted. There's a positive slope, especially between the widely followed and closely followed, I should say, 2-year, 10-year spread. Now, we still have the Fed to worry about, and we have seen that Powell is a guy who is prone to or susceptible to bullying by President Trump. So we may get another rate cut, although you start to hear some dissident voices inside the Fed saying, hey, we don't need another rate cut. Let's give it some time. I mean, the stock market, the S&P, is less than 2% from its all-time record high. The economic indicators are pretty decent. So you have some people within the Fed saying, you know, we ought to hold off. But if the Fed does go ahead with one more rate cut, here's the thing. If it goes ahead with one more rate cut, and if it lowers the rate down to 2%, then we should see, and if it says at that point, okay, we're done for now, we're going to sit tight, we're going to see how things go, you should see the 10-year back up to around 2%, 190, 2%. We're at what, 162 today? That's not far away, all right? Another 28 basis points. It's not that far away. So I think that's the scenario. I think that's what's going to happen. They might cut one more time as that quote-unquote insurance cut, which is really not necessary. But Powell, and you know my position on Powell. I mean, I made that very clear from day one, from the minute he was put in there. The guy has no clue. He's the worst Fed chair since Paul Volcker. I mean, Janet Yellen could run circles around this guy, and I wasn't that crazy about Janet Yellen either. But she can run circles around this guy in her understanding of at least things like monetary operations and the Fed's role and interest rates. This guy, I mean, he's a securities lawyer. He doesn't know anything about what the Fed's role is, and basically he just caves into whatever the market demands or whatever Trump demands. He has become, he's been publicly bullied on Twitter and allowed himself to have that happen to him. So, I mean, he's just been a terrible leader of the Fed. Anyway, I digress. So that comes at the end of this month, the 28th. We'll see what happens. But again, I will point to the fact that nobody is mentioning the connection or making any sort of an effort to show there has been a connection between the debt ceiling and the distortions that created and the bond market and yields. Nobody. It's always, hey, there's going to be a recession. I mean, they keep pointing towards this kind of apparition of an oncoming recession, and there has been no real economic data to support it. Unemployment is very low. Hiring, although the payroll numbers we've seen have come down a bit, they're still positive month to month. Retail sales, very positive. All these indicators I've been talking about, bank credit, oil prices. By the way, oil prices up to 58 today. Who was long the whole entire time? Who had subscribers long the whole entire time when it was dipping down 53, even a 52 handle? Those weekly analyses that I send out based on the EIA, Weekly Petroleum Status Report, always showed us strong demand, inventories coming down, exports going up, imports are low. I mean, there were all the ingredients. And not only that, we saw that commercials and oil producers themselves have been net long oil futures for the last 14 weeks straight. In that whole period of the zigzag between $53 and $57, these guys were long. And now it's breaking out to the upside. All this stuff plus much more comes in my weekly report, MMT Trader, and not to mention the many emails I send out daily updating my subscribers. Anyway, go to my website, pitbulleconomics.com, sign up for a 30-day free trial. See everybody tomorrow. Bye-bye.